I'd like to thank everybody for joining me today. Today, I want to talk about buy-sell agreements, but more importantly, how we value the company and how we set up the payments under the buy-sell agreement. I think a lot of times we spend more time on talking about why we need buy-sell agreements or what type of buy-sell agreement, but we have to dig down in the details and make sure that we're doing the best for our clients and how we structure these types of agreements. When you look at buy-sell agreements, we have, really three different types of buy-sell agreements that we can use. We have cross purchase. So if we have a limited number of owners, cross purchases work great. One owner says they'll buy out the other partner when there's a death or, whatever other triggering event. With a redemption agreement, the company is going to buy that interest from the individual. I find that redemption agreements are usually, more attractive when we have, a lot of various owners to where a cross purchase might not be as advantageous in the design. And then we've got the hybrid, which really combines it and gives us the option to either treat it as a cross purchase agreement or as a redemption agreement. And the person that gets to decide that is the buyer of the ownership interest. So they get to wait and see what's the most advantageous for them at the time the sale is going to happen. Now, let's be honest with this. From the seller or the seller's family's perspective, it doesn't change, it doesn't change anything for them as to how they receive the money under any type of these agreements. It does affect the buyer and the buyer's, future, tax basis and where the money's is coming from. So as you look at these, we have to look at the impact from the buyer and the seller, but the type of agreement honestly will affect the buyer way more than the seller. As we look at this, you've got your buy-sell agreement. The big question comes in, how do you value your company? And I work with a lot of different business owners, and through the years, I'll ask them, what's the value of their company? And a lot of them don't know. And it's one, well, I hope I can get X or I hope I can get Y, but they really don't have a good handle on how their value a company should be valued, especially in the type of business they're in, because the valuation is going to vary, business to business, industry to industry, depending on, how good their company is, the type of industry they're in, all of those things affect their business. So when I start looking at valuation methods, probably one of them that just jumps out there is just an agreement among the owners. Now, this is okay if the owners are realistic in the value of their business. Now, I've worked with companies where they've come in and said, okay, we've agreed our business, if something happens to any of the owners, we'll buy each other out for $1 million. Now, is that a realistic valuation? I don't know. And in some cases, they probably don't know. But it's one, if you want to have your buy-sell agreement set up among an agreement and valuation of the business owners, that's your prerogative as the owners of the business. Now, there might be issues when you're looking at estate tax valuations from the IRS perspective. They get a value at best use. And so there can be some estate tax complications here that we have to overcome. There again, that's something we'll just have to address for each of the owners. The next one I see is where they just kind of punt this and go to an appraisal. Now, I like appraisals when I'm working with business owners that really just don't know what their company's going to be valued at. I've worked with business owners, they get ready to retire and they truly don't have a handle on what it would cost what it would be if they sold their business. So bringing in an appraiser isn't a bad thing. And it's one where it may set a baseline for all the owners to really start, coming to an agreement. What I don't like on an appraisal is when in the buy-sell agreement it says, okay, partner A died, now we're going to bring in an appraiser. And typically what I'll see in a buy-sell agreement is, well, the seller's family gets to name an appraiser. The buyer gets to go get an appraiser. And if there's a problem, they can both hire a third appraiser. So you look at it, it's like we've got an agreement to buy it, but now we're just paying professionals at the worst time to be coming in and valuing it. So you just punted the problem down the road because you didn't want to deal with it. There again, appraisals aren't bad. It's just understand the cost, that you're going to have, especially if it's a timing issue and those other things. It's just can be expensive and there again, it is what it is. What I do like from, using the appraisal, especially if we're getting an appraisal now, is we can figure out what is the formula for your business, for your industry. And I like a formula because now if we know what the formula is, we can come in and say it's going to be your EBITDA or it's going to be your gross sales times a multiple. And if we understand from an appraisal standpoint what the best appraisal method is, then we can create that formula. So when somebody does pass on or somebody leaves the business, we don't have to go get another appraisal. We don't have to worry about an agreement among the owners that may or may not be in reality. We can just plug the numbers into this formula and everybody knows what that is. So, hey, if you want to boost your sales before you retire, okay, maybe if your buyout is based on gross sales, gross revenue, all right, boost those numbers. Let's make it look good. So the formula to me is a very easy way to approach this because when we hit a triggering event, we just have to fill in the math equation. Once we have the value and all of that figured out, now we have to look at how is the seller going to pay for that? What terms do we want to put in for the payment of the purchase price? Now, if we go to the easiest, can we just have a cash out? Do each of the partners, if we have two partners, three partners, doesn't matter. Does the surviving partner or partners have the ability to just make a cash payment? Okay, that's easy. Partner A leaves, partner A dies, whatever the triggering event is, the remaining partners come in, can have the ability to write a check, and we cash out and we're done. Now, this is going to probably be more rare just because, it's hard to come up with those value, those numbers. Could be a good time to create the cash payment, or it could be a bad time. There again, the timing's going to do a lot for that. A lot of times I'll see installment payments. There again, installment payments, we just have to understand we've got the down payment, the term of years, and the interest rate. If that's what it helps to create the right cash flow numbers for the buyer to be able to handle this purchase. Now, a lot of buy-sell agreements that I read through, it's going to say a 10% down payment. It's going to have installment payments over a 10-year period, and the interest rate is going to be somewhere tied to a prime interest or set at, current prime. Whatever it is, as long as the owners agree to it, I don't have a problem with it. They just have to understand, as the buyers of this, they have to earn that money from the business, pay their taxes, and the payment is going to be on an after-tax basis. Finally, I like looking at life insurance for buy-sell agreements. When I look at life insurance, the big part that comes to me is leverage, especially leverage of the death benefit. If we have a leverage on death benefit, maybe we're going to get a 10x multiple on the leverage. This gives us the buyers the ability, if there's a death, potentially a disability, they've paid in less into these policies so that they can have that money to pay out the seller, at death or whatever other triggering event. I also like using cash value life insurance. It allows the buyers to create a sinking fund. If I'm the seller, it'd be nice for me to know my family's protected because if I leave the company in a retirement, disability, whatever, there's cash value there to either pay off my family or at least pay the down payment of the installment note. So life insurance can create that leverage. It can create that sinking fund. It's just a good tool in the buy-sell agreement. Finally, the big thing is to start the conversation. Have these conversations with our business owner clients. so that they can make sure the transition's happening, that they think through each of these different variables so they get the right agreement. So I appreciate everybody being on, and we'll talk again next week. Thank you.